Hello and welcome back to another episode of How to Invest $10,000, the weekly series where I invest $10,000 into stocks, real estate, or really anything that I see fit and share it with you guys here on the channel. So just like we do every week before we hop into things, I'm going to share with you guys exactly where the account is at the time of recording this video. And today is July 23rd, 2022. And at the time of recording this video, we have $10,381 in the account that we've been investing in so far, which is pretty dang good considering that we are still in the midst of a bear market and we are making money, ladies and gentlemen. And actually, throughout this week, we had actually hit an all-time high for the account at around $10,500. So at one point, we were actually up 5% this week. But as of right now, at least, we're still up $381, which is 3.8%. So feeling pretty happy about that considering that we're in the midst of a bear market. So I have a really awesome episode for us planned out this week. So what we're going to be talking about is a little bit of some of the catalysts coming up next week as far as like the GDP numbers coming out, finding out if we are officially in a recession, the Fed rate interest decision, all these different things that are going to be major volatile market moving events that are happening next week. And on top of that, we're going to touch a little bit on what happened with Tesla earnings. And then also I'm going to be talking to you guys a little bit about some sectors that are actually associated with some of my plays that we did in the account this week. And I'll tell you exactly why I'm diversifying into certain sectors because basically we feel like there's some sectors out there that are going to outperform the market. So we're going to talk about those in a little bit. But before we get into those couple of last things, we're actually going to go through our weekly moves. And in this case, it's 2 weeks worth of moves because we actually missed an episode last week, which won't happen very often, but it was Tesla earnings. So I had to prioritize some other videos in order for that to come out on time. So this week it's kind of 2 weeks worth of content as far as our weekly moves. So just have that in your mind when we're going through these. But yeah, let's go ahead and jump into weekly moves very first. All right, so now that we got Robinhood on screen with you guys, let's go ahead and start kind of breaking down where the account is at as of this time. So as you can see right there, buying power is at $49.84. So yes, we've used about 50% of our cash and we're about 50% in the market, 50% in cash now. And I expect that we're going to be deploying more of that cash next week as we get to these, major catalysts like I was talking a little bit about earlier. And we'll still talk about those here in a minute. But going into our actual holdings that we have right now, as you can see, we still have hardly any Bitcoin, like 200ths of a Bitcoin right there, but we are up 4.5% on that. We have 2.89 Tesla stocks, and as I told you a week or two ago when I bought a full share, the reason I did that is because I knew we were getting closer and closer to earnings, and truthfully, even though I bought it at not the best point just because I thought the stock was going to go for a run, anticipating good earnings results, I wound up getting the share at like 762 or something, but yeah, we have almost 3 shares of Tesla, and we are up 11.4% on our Tesla, guys, which is just phenomenal. Our Nvidia, we have about a half of a share there, up 7.8%. Google, almost a full 3 shares, but we're actually down on our Google position about negative 2%. So yeah, we're taking a little bit of a loss there on Google, but that's just because of our actual Snapchat earnings that we had come up this last week. And it kind of scared the whole advertising space because, Snapchat just missed like massively. And I mean, their stock got crushed. So we had some sympathy trading going on there at the Google space and also at like Trade Desk and Meta, all the other advertisers on the market. After that, we have 4.4 shares of AMD, and we are up a tasty 11.34% on that. And our TQQQ position, this was actually over 20% up at one point this week, but now we're sitting there at about 14.1% up on this. Got 24 shares of that, so obviously our leverage play that we're trying to do in place of options is working really well, and I think that we're still going to be wanting to add more to this TQQQ, especially in the week coming up when volatility does arise, and if we do get some big red days on the NASDAQ, definitely going to be loading up some more shares of that TQQQ. I just think it's a good time to be trying to get into some of that broader based leverage play on some of these indices, because in my opinion, and we'll talk about this more a little bit later, but in my opinion, I think we are getting closer to a bottom. So we'll talk about that more in a minute. But also Microsoft, 1 share of Microsoft, we got 1.1% up on that. Now for these new positions, guys, and these are the ones we're going to talk a little bit about later, we got VCR, XLI, VOX, XLF, and VGT. All those up right around 0.5%. Because truthfully, just barely bought those on Friday, so it hasn't had a lot of time for those to actually, do much movement. But we'll talk about those here next. Okay, so now let's talk a little bit about these new ETFs that we just barely opened a position in this week: VCR, XLI, VOX, XLF, and VGT. So where this really all started was I read a piece of research that was done actually by MarketWatch, and I'll go ahead and put this article up on screen so you guys can kind of take a look at what the headline is for this article. The headline is, "These sectors of the stock market are expected to show the best earnings growth." So the reason that this headline actually stuck out to me and made me want to read it was because, in my opinion, we have already experienced a lot of multiple compression. And when I say multiple compression, compression, I'm talking compression on PE ratios, PEG ratios, actual valuation metrics that are used to prop up basically what we have as far as an EPS number, right? So basically, like for example, like if you have a company trading at $1 EPS and it's trading for a 20 times multiple, then obviously the stock is worth $20, right? So that's pretty basic to understand. So the reason that this article actually stood out to me is because we're actually talking about earnings growth in here as far as which sectors are expected to have the best earnings growth. And yeah, we might see PE also grow in certain sectors, but in my opinion, I feel like PEs are at a pretty just level. They're right around the mean of where they usually trade at. So really, I don't expect PEs to go up or down very much from this point. So we need to be focusing in on where we're going to be seeing earnings growth at. So in an effort to save you guys some dry reading, if we scroll down here to this chart in particular right here, they actually talk about different sectors and what the estimated EPS is to be made up of the S&P 500 in said sector and how much it's expected to grow or change between 2023 and 2024. So we can kind of look out, actually 2 years into the future of earnings growth per sector. And so what I actually did was I did on my own paper here is I wound up totaling up how much, like as far as a percentage number, which one of these sectors are going to be, the highest growing and then the lowest growing. And what I did was I found there are 5 sectors that are actually set to beat out the S&P 500, which is set to grow about 19.6% between now and 2024. So the 5 sectors that are actually set to outperform the S&P 500 are consumer discretionaries coming in at a 56.9, which is crazy. That's huge earnings growth. You got industrials coming in at 33%, communication services at 32.8, so basically another 33. And then 4th place is financials coming in at 27%. And then we have 5th place for information technology at 20%. So what I did was I took this information going, okay, we have 5 sectors that are basically set to outperform the S&P 500, or at least as far as what we're expecting right now based on current research that we're able to get at this time. So what I decided would be probably a decent idea was to diversify into all 5 of these sectors in case, one winds up not performing as well as they're thinking it could. And, the way that I've thought to do this was with ETFs. There's plenty of good ETFs out there that hone in on specific sectors, and that is exactly what we did here. So VCR, that's our consumer discretionaries. XLI, I can't remember. Let's go into that. XLI, that's your industrials right there. VOX, I think that's communication services. Yep. And then XLF, that's financials. And then VGT, that is going to be our information technology. So what I decided to do was once we actually knew these sectors, I kind of took the top 3 and put a little bit more money in those top 3 sectors, expecting them to outperform more than the others. So basically we put $333 into the actual consumer discretionaries, into the industrials we put $333, and on communication services we put $333. You can see all of those right there, placed trades on July 22nd, that Friday. And then as far as our financials and our information technology, I put $100 into those. Now on top of this, on top of making this initial investment, this initial trade to actually get those positions started, I also added these to our recurring investments. So now every single day, every single market day, I should say, we're going to be buying $10 of each and every one of these funds. So yes, I kind of weighted it a little bit differently at the initial investment, but going forward, just in case one of these actually underperform a little bit, I want to actually be evenly dollar cost averaging into these specific sectors. So yeah, I mean, that's my investment theory on this as far as why I'm doing it. And the reason I went with ETFs instead of trying to pick stocks is because truthfully, some of these sectors I just don't have the time to go into and actually find the best stocks within those sectors, because right now I feel like we're nearing the bottom of the market. Like I've kind of already told you a little bit earlier today, I feel like we're nearing the bottom of the market. And so truthfully, for me to take the time and go do a real fundamental, detailed analysis on companies within some of these sectors that I hardly ever invest into would take more time than what I really want to be able to spend to get into the position sooner in case we continue to see this rally go up, So to me, I'd rather just, diversify into the whole broad sector. That way I don't have to go into some of these sectors and try and find, my favorite stocks out of those. We already have some favorite stocks. I mean, obviously we love our Tesla, we love our Nvidia, I love my AMD, I love Microsoft. These companies are really the ones that I've done full fundamental analysis on. I know these companies well. I know what I expect out of these companies, but I don't have time per se in this market right now to be going and looking for, an industrial company that I love a lot, or a financial institution that I want to invest in, right? I mean, I'm sure that a lot of you guys might have one that and if you do, that's great. Maybe that's one of your high conviction stocks that that you guys are investing in. But for me, I know my high conviction stocks are mostly tech, and I want some more diversity in the account. And so for me, doing this ETF play and getting into these sectors that are set to outperform the S&P 500, I feel like it's going to be a really good move for the account going forward. All right, so now that we've talked about these new ETFs that we open positions in and the why behind opening these new positions into these ETFs, let's actually look back on the last 2 weeks of trading history so we can go through all the trades that we've wound up making in these last 2 weeks. So let's go ahead and start here on July 11th. So obviously our recurring buys are just happening going forward, right? And then here on the 13th, I bought $100 of Tesla, $100 of TQQQ, $50 of AMD, $50 of Google, and $50 of Microsoft there on the 13th. Now going forward, more recurring investments, and for some reason these recurring investments just don't go through. I don't understand what it is, if they're just not placing it as a market or if it's a limit or something, but really kind of annoying when they don't wind up going through. But anyway, continuing on, didn't make any more trades until the 15th. And on the 15th, we bought another 100 of TQQQ, got 200 of Tesla actually, and then we also got $100 of Microsoft right there. Going forward, more, there's Google split, as you can see, 20 for 1, and then we keep going with more recurrings, and then here comes the 18th right here, bought 150 of the TQQQ, bought another $100 of Tesla there on the 18th as well, coming into earnings, getting excited about it. We had good expectations going into this. I felt really strong about Tesla earnings going into them, so I just kept adding on the days before. More recurring investments, and then on the day of the 20th, when Tesla actually reported its earnings, I remember I was listening to the earnings call. It was after hours, got done with the call. I went, man, this was actually really strong. And at this point, Tesla hadn't had its 10% day yet, right? So we're talking after hours on the night of July 20th. I think Tesla was sitting, where was it at? At 7:48. Yeah, you can see right there, filled at 7:48. So that night I was going, man, these were actually really strong earnings. I can't believe the stock hasn't moved yet. So I was like, you know what? Let's just put another $250 on Tesla tonight. And literally the next day, the stock went up like 9-10% or whatever, up to the 820 or whatever it hit that next day. Anyway, continuing on, we had more recurring investments happen. And then here on the 22nd, bought $100 at Google, $100 at TQQQ. And then here are the trades that we already talked about going into those specific sectors via ETFs, and then after that, just some more recurring buys happening over on yesterday and today for my Bitcoin. So yeah, that pretty much sums up what's happened in the last 2 weeks as far as all the trades that have been made for the account. So that kind of catches you guys up on that. So that basically sums up all the moves that we actually made for the account in the last 2 weeks, but I want to hurry and talk a little bit more about Tesla and the earnings report that we wound up getting from Tesla. Guys, it was an extremely strong earnings report in my opinion. There was a lot of FUD going on around Tesla before the actual earnings happened. A lot of people saying, hey, this is going to be a really nasty quarter. We're going to see some really bad things. We had people, lots and lots of people talking about how Tesla was going to go down to 400 a share, all these different types of things. And guys, truthfully, when it comes to these companies that are high conviction stocks, you have to be so solid on your fundamental analysis. You have to be so solid on understanding these companies to know that you have that conviction. You have that actual that mindset that yes, no matter what this earnings report is, I'm either going to add more when the stock goes down or I'm going to be freaking happy when the stock goes over the 800. Now, in our case, we were really happy that the earnings met and actually beat expectations of our own. And, truthfully, when we talk about the quarter for Tesla, it was a really hard quarter. Shanghai being shut down, one of the highest margin factories that they actually have, that's going to impact things. And truthfully, we were thinking that it was going to impact things even worse than it did. Yes, we had more S and X sales. So yes, our margins were propped up by us being able to deliver more Model X and more Model X's. And so that's really good and it helped us out a lot. But the truth is that it was actually really impressive, the fact that Tesla was able to come out and have the EPS beat that they had with the problems that they were having at the Shanghai factory. And considering that they were in the midst of still trying to ramp up Berlin and Austin at the same time as all that was going on, guys, it was phenomenal that they came out with the numbers that they came out with. And truthfully, the guidance going forward, it was also really great. We have some really good information going forward about that. Austin and Berlin are going to be coming out with about 1,000 vehicles per week as far as what they're able to produce. And that was happening in June. But if you guys want even more detail on Tesla's last quarterly result, as well as what was said on the earnings call, I'm going to suggest that you guys check out my last video that I just barely posted, which is basically a full earnings call recap, as well as talking about the results of Tesla's last quarter for Q2. I'll leave a card for that here just on the screen somewhere. You guys can go ahead and click on that, and you guys can check out that full video for more detail on exactly what was said in the earnings call and exactly what's expected to happen with Tesla from this point forward. And as well as a bonus at the end of that video, I actually do wind up giving you guys my end of year price target for Tesla stock as of right now. But anyway, enough of this Tesla tangent. I just feel like it's important to talk about it a little bit since it's one of our largest holdings in the actual $10,000 account. And I just feel like we need to talk about these high conviction companies of ours when they have important catalysts come up for them. I mean, this is all part of investing. And if you're trying to learn how to invest by watching my ideas and getting my perspective on this series, then truthfully, I feel like it's really important to ingrain in you guys that yes, part of investing in single individual companies means that you have to be doing the research. You have to be going through these earnings calls. You have to be reading these 10Ks, these 10Qs. Yes, it's boring, it's dry, it can be a little bit, tedious to do so. But trust me, if you're going to be investing in a singular company and not trying to diversify via an ETF, then it's more important that you go through these things because you need to understand these companies. Because if you don't, then you're going to miss something and it could burn you really, really bad, especially since you're, less diversified when you're in a singular stock, which once again kind of hints why I went into the ETFs to try and cover these 5 sectors. I don't have time to do that for so many dang companies. I mean, we have a lot of high conviction companies already to where I have to spend time to go through these all the time, keep up with the news in between our earnings reports, everything, build projection sheets on them. It takes a lot of time to follow a single company. So when you're unsure, ETFs. And it's a really great investment tool, truthfully, guys. A lot of people underestimate the power of ETFs and they think it's boring and just not fun. But if you're trying to be, an actual like medium to low profile risk on your investments like I tried to obtain, then ETFs are a really great tool to do so. All right, so now let's go ahead and jump into our final segment for the week, market news. All right, so first thing I want to do is we're going to actually recap some of the news that actually happened this last week, and then we're going to talk about upcoming catalysts in the week ahead, which is actually what's really important, what's actually going to be moving markets. So make sure you stick around for that. So first thing that came out was on Tuesday, July 19th, we got our building permits for June, which actually came in at 1.685 million, which beat the forecast just slightly, and the forecast was 1.65 million. So a little beat there. It shows that we have some more homes as far as new home building continuing, which is a good and bad thing if you're looking at it from a housing market perspective. I mean, right now we're seeing a big slowdown in demand and a big slowdown in buyers. So if we have all these building permits being pulled for new homes, and maybe there's not buyers for these new homes, that could just add to supply, which would wind up actually hurting housing prices in the long run. Just kind of depends on if these homes for the permits that they're pulling are already pre-sold homes, or if these permits they're pulling are homes that they're just going to kind of build as a spec home and then try to sell as a builder themselves, right? So that's kind of a big thing for the housing market. It could bring even more pain for the housing market is what I'm trying to allude to. Next, on Wednesday, July 20th, we had existing home sales actually come in at a miss of 5.12 million, and the forecast was 5.38 million. So a little miss there, nothing huge, but that's even just more insult to injury there with the building permits showing that, yeah, home sales are slowing down even with existing home sales. We've been seeing new home sales definitely slow down a lot, especially I think it was 2 or 3 months back. We had a huge miss for one of those months, but here's another indicator right here with existing home sales slowing down. Just shows that overall these higher interest rates that are here in the market, it's definitely limiting how many buyers are actually out there looking to buy a house right now. Now next, after that, the same day on July 20th, we had our crude oil inventories come in. We actually came in at a negative 0.446 million, so about 446,000 compared to the forecast of 1.357 million. I really don't pay too much attention to energy because truthfully, I'm just not touching energy right now. I feel like it's at too high of a point to really be safely investing in it. I know that Warren Buffett and a couple of other big names are investing into, big energy companies, but myself, I feel like those have got to be short-term plays because looking forward, I mean, like we were talking with sectors, one of the sectors that's poised for one of the worst returns actually right now is energy. Energy between now and 2024, the earnings are expected to go down 20%. So I'm just avoiding energy at all costs. I don't even want to really talk about energy too much. Yes, it sucks right now that gas is super expensive and that's leading to inflation. So we'll talk about it there. But as far as like talking about investing into oil or energy companies, I don't even bother with it. Energy companies, I shouldn't say all energy companies. Like if it's a solar company or something else, then yes, we'll talk about it. But oil in general, I don't really care for it too much. So going forward from there, on Thursday, July 21st, we had our initial jobless claims actually come in as a beat as well. And it's not a good beat. It's 251,000 initial jobless claims versus the forecast 240,000. Same day, Thursday, 21st of July, we also had Philadelphia Fed Manufacturing Index come out, and that came in at a negative 12.3 versus a negative 2.5. All right, guys, so now let's move on to next week's news and some of the catalysts that we're expecting. And let me tell you, we got some really big catalysts like we've been alluding to all video. So first thing is coming out on July 26th, that's Tuesday, we got our consumer confidence report for July. It's forecast at 97.3. The last report, just to give you an idea, came in at 98.7. So they're forecasting it coming down a little bit, which really isn't super big surprise. And truthfully, I would expect them to actually miss to the downside on that number as far as consumer confidence. I feel like it's going to fall quite a lot in July. New home sales. Now that's also for June, so not July. So this one's a little bit of a lagging indicator. But new home sales, they're forecast to come in at 664,000. We'll see how that comes in. I expect a downward miss on that one as well. I myself am in the construction industry for my 9 to 5 that I work, and let me just say it's slowing down quite a bit. So I definitely expect new home sales to be slowing down even on the national level for June quite a lot. All right, so now talking about Wednesday, July 27th. This is one of the big days, guys. This is one of those ones you want to mark your calendar for. It is the federal interest rate decision day. So this is the day that they actually decide whether they're going to go with the 75 BP hike or if they're going to go with the 100 BP hike. So right now, the actual market is pricing in with an 80% possibility that we're going to be going with the 75 BP hike, while with about 20% probability we could go with the full 100 basis point hike. Now, this changes every single day. So as we get closer and closer and closer to our actual interest rate decision, who's to say that it might swing back up and they might decide that they're going to go for the full 100? So at least at the time of recording this video, looking at the Fed rate monitor tool, it looks like we're pricing with it about an 80% probability that we're going to go with the 75 basis point hike instead of the 100 basis point hike. Now, the 100 basis point hike is priced in at about 19.5% probability, but the thing is that you got to know is that these numbers kind of change. So it could change leading up to the actual 27th, the actual day that we decide the rate. Now, I suggest that everybody goes on to investing.com and uses the Fed rate monitor tool leading up to the day of the actual decision. And the reason why is because we're going to want to know what the market is pricing in leading up to it. Because if the market is pricing in a 75 BP hike and all of a sudden we get the 100 BP hike, well, obviously the stock market's not going to be very happy about that. So going into the actual day of the decision, I always like to take a look at the Fed rate monitor tool, and then even on the days leading up, so that way I have an idea of what the market is pricing in. Because usually the truth is that most of the time the Fed will go with whatever the market is pricing in. And the reason why is because they like to try and keep credibility with the market. And so if the market prices in one thing but they do another, well, that's kind of a hurt to their credit. And as we learned in the last FOMC minutes, then obviously one of the things that they're trying to obtain and trying to keep is their credibility. They want to hold on to that credibility because that means that when they come out here and talk and have some of their actual participants come out and talk in front of markets or on the news media outlets or whatever, then sometimes they can actually have some of the tightening done for them with that being the case because they have that credibility. So if they have, if they have Bullard come out and say, oh yeah, we're thinking about doing the 100 BP and they're trying to instill some fear in you, you might see the 10-year treasury tick up from him talking. When that 10-year treasury actually ticks up, then, that does some of the Fed's tightening for them without actually having to adjust any monetary policy. So they're trying to keep that credibility. So if we're pricing in a 75 BP hike right now, it is most likely that we're going to go with that 75. So now the day after the federal interest rate decision is July 28th. And this is another big catalyst day, guys. Also mark your calendars for this one. On this day, we're going to be getting our actual GDP quarter over quarter growth number. And this is going to be the day that decides whether or not the US is actually in a recession. So you better bet that people are going to be all eyes on this GDP report for Q2. Right now, as far as what I'm able to see as a forecast, they're expecting us to come in at a 0.4%. But as we've seen at the Atlanta Fed, that's not necessarily going to happen. So let's hurry and just jump over there right now and take a look at what their GDP Now tracker is actually saying. We'll do this together. So we're going to go into GDP Now, Federal Bank Reserve of Atlanta. All right, so right now, their last estimate was on July 19th, and they're estimating that we're going to come in at a negative 1.6% Q2 GDP. So we'll see who's right. Investing.com says that we're going to be going in at a 0.4 positive, which would mean that we narrowly avoid a recession. But if the GDP Now tracker is right, then we are going to be officially in a recession. So after the GDP numbers, the very next day on July 29th, we have our core PCE data coming in, and that is going to be another huge market moving catalyst. So, they say that good things come in threes, so, hopefully 3 big catalysts in a row. Maybe that means it's going to be some good information on all 3 of these. Or at least we can cross our fingers and hope so. But yeah, July 29th, PCE is coming out as well. So another big catalyst. And for you guys that don't know what PCE is, this is basically what the Fed's favorite way of monitoring inflation is. So they use this PCE number basically like a CPI number, if you guys are familiar with that, which is another inflation measurement. But yeah, for any of you guys that don't understand what PCE is, it's just another way of measuring inflation in our economy, and the Federal Reserve likes to use the PCE a little bit over the CPI. So a hot report would be bad, where a cool report, where it comes in under estimates, would be good. And right now, as far as the month-over-month core, which is the most important metric that we look at, they're forecasting our month-over-month on core to be about a 0.5 on our PCE, which is actually an increase from the previous month that we came in at a 0.3. So yeah, anyway, guys, that's going to sum up everything for this week. I mean, we went through all of our stuff from our weekly moves, talking about the new sectors that we're trying to invest in. We talked about our Tesla earnings, and we talked about the huge catalysts that are coming up this week ahead. So yeah, I think that we've covered all the bases for this episode. If you guys enjoyed this episode, make sure you do me the favor of hitting that like button down below. And if you guys aren't subscribed, well, what the hell are you doing? So make sure you hit that subscribe button down below, as well as make sure that you turn on the notifications so you get notified every time that I do upload a new episode. But anyway, guys, until next video, peace.